your margins, as we said before, you want them to be high. So you're looking at last year, and then you're looking at this year, and you're comparing. With all of these numbers, with ratios and calculations, the number on its own doesn't tell the story. It's all about the comparison. So what was it? What is it now? How did that happen? What has changed? If it's positive, you need to make sure you look at it just as much as if it was negative. So if your gross profit margin was 20% last year and then 40% this year, why is that? Is it because, for example, you've taken on more staff, so you're not paying agency rates, staff costs, which would increase your gross profit margin? Is it that you've gone to a different supplier for your goods, so that's increased your gross profit margin? Is it that you have less idle time now with your workers because you've given them different things to do instead? So there's various different things you should be looking at. So gross profit margin, operating profit margin, and net profit margin. All of that information will come from your financial statements. Being specific, it will be your income statement. There is a return on capital employed. And basically what that's saying is, for every pound I invest, what's the return? And that's really useful for an investor, because let's say with their bank account, they can get 4% interest. Might not be able to get 4% interest, but let's say they can. They're not going to want to invest in any other business that will only give them a return of 3%. So they want to know what the return on the business is. So you should be able to work out all of these figures for your businesses using your financial statements. Or ask your accountant to, and then look at those numbers and be aware of what they are. You can even, in your business plan, include what you would like them to be. So you might have it set at one thing. One of your objectives might be, I want to increase my gross profit margin, or I want to improve my operating profit margin. We've got a couple of others to show you. And if you want to go in detail through any of these, I'll be happy to do so later. Asset turnover, your distribution costs as a percentage of turnover, and your admin costs as a percentage of turnover. So these ones that I'm showing you are profitability ones, and they're ones that people use in business as standard. That's not to say you can't use additional ones, all right? These may not be relevant to your business. Only you will be able to decide that. As I said, this is part of management accounting, so it's all about your choice and what works for you.
When do you get these slides?
They'll be sent out by Velocity to you.
When, like?
Today.
Today? Oh, by email?
Yeah.
Okay.
And then if you've got any questions about that, feel free to ask me. My business card, if you want it, is there if you want to ask me any questions. You can take that later. I said it wasn't going to involve maths, which is why I'm not going to demonstrate too much with numbers and calculators and getting them all out. But if you do get stuck on doing any of these for your businesses, I'm quite happy to come and speak to you and help you understand what these numbers are showing you. Because as I said, it's not just about the numbers, it's about understanding what they mean. That's more important. So we've showed you some profitability ratios. There are some other ratios here. I know it's lots of words and things like that, and until you put it into context, it doesn't make too much sense. But you have a current ratio, you have inventory days. Inventory days is how many days you're keeping your stock in, so not necessarily relevant for a solicitor, but it might be relevant. We used to use this a lot at a garage that I worked at. They would want to know how long all of the parts are being kept, because parts become obsolete after a while when there's a new model of car. So you don't want that inventory days to be too long. Also, another reason, you don't want your inventory days to be too long because your cash is tied up in that inventory. Yeah? And not only is your cash tied up in the inventory that you're holding, it's tied up in that person making sure they're doing the ordering and how many times they're ordering, in the warehouse that it's kept, the lighting, if there's warehouse staff. So you don't want your inventory days to be too high because it's tying up your funds. Receivable days is your debtors days. So this is how long is it taking me, on average, to get my money in from my customers. Yeah. And you want that to be low. Your payable days is how long it's taking you to pay your suppliers. So do you want that to be low or high?
Low-ish.
Okay, why low?
So that if you then wanted credit from them, they're not going to turn around and say, well, you didn't pay us on time. But at the same time, you don't want to be paying too early because your cash flow.
Yeah, so actually it's not low or high,
Yeah,
it's in the middle is
depends
really
on
what
who
you want.
you're paying.
Yeah, most people tend to say high. So you're a good, like, I'll do lots of customer review because you're going to pay me on time.
Only because I've got experience.
Yeah, you don't want your payables to be really, really high because otherwise you're probably not going to have a great relationship with your suppliers, and at some point you may need a favour from them. Sometimes you might need something delivered quite quickly from them. You don't want to really know, it's not fair, it's not good business practice. Whereas you don't want it to be so short that they send you the invoice today and you've paid them by the end of today, when they actually gave you 30 days. What would be better is to pay them in 30 days when they've asked to be paid. Yeah? So it's a balancing act a little bit. And as we said earlier, you know, if people are shouting at you to pay, you might end up paying them a little bit earlier.
Yeah, it depends on how valuable you think that.
Depends on the relationship,
Yeah,
doesn't it?
definitely, and how much you need them as much as.
And then gearing is another investing ratio. I'm not going to talk too much about these because they're quite in detail, so you can speak to your accountants about these and whether they're relevant to your business. But I've given you the calculations so that you could do them with your financial statements. Now, I'm just bringing up this slide again because it's relevant at this point. So this was all of the different type of users that we had earlier. We spoke about investors in specifically, we spoke about banks, suppliers, government. They're all going to be interested in our financial statements. They're probably going to be interested in some of those ratios as well. They may ask you for specific ones depending on what they want. Now, what I would like you to do, a bit more homework for you, or a bit more work for you to do now,